Hello, everyone, and welcome. Thank you for joining our webinar this afternoon. Our topic today is investing in the midst of uncertainty. We're going to give you perspective on the coronavirus and its impact on the markets. I'm Justin Cassada, Director of Client Service here at Brown & Company. Today's discussion will be led by Mark Brown, Managing Partner and Founder, as well as Chad Hamilton, Director of Practice Management. I will say that we are using the Zoom conference software for this webinar. As you can imagine, these remote conferencing platforms are certainly being tested, with a large portion of the country now working remotely. If we do end up having technical difficulties, we will make sure everyone receives a copy of the slides along with the call replay information. We'll cover our presentation and prepared remarks within the next 45 minutes and then answer questions that come up. For the Q&A portion, rather than open the lines for questions, please type them in and we'll attempt to answer as many as we can at the end. We've sent out a number of written communications, at least 1 or 2 per week since the end of February, when the coronavirus news first shook the markets. Those that have been receiving our emails should be aware of some of our thinking about the current environment. If you have not been receiving these emails, please reach out to me separately after the call and I'll get you signed up. We have close to 100 people on this call today. Many of you are clients, some business associates, and others friends of the firm. I'd like to quickly mention, for those of you that do not know us that well, we're a comprehensive wealth management firm. We've been in operation for over 30 years. Mark Brown, founder of our firm, has been receiving awards as a top advisor for more than 20 years now. I'm proud to announce that Mark was recently named a top 10 advisor in Colorado by Forbes magazine, and just last week was named a top advisor in the country by Barron's Magazine for 2020. With that, I'd like to pass it over to Mark.
Thanks, Justin. Well, first and foremost, I want to thank all of you for taking the time out to hear what we have to say. And it's always true that when we're going through dramatic times, people are more interested in having these types of presentations, so we're really happy to do it. We've given a lot of thought to it. Chad Hamilton has put a great deal of effort into it, and so we think we hope it hits home as you listen to what we're going to say. Some people are asking me when I talk to them, as I'm talking to clients and friends, are you getting a lot of phone calls? And I say, oddly not, and that always surprises people, and we're trying to reach out to talk with our clients as well without them having to call us. But because we're a planning-based firm and that we've got a certain methodology of organizing our client finances through good times and bad, and always being prepared for the unknown, it seems our clients over the years have gotten comfortable with that methodology and know that we're doing everything we can to both provide opportunities to them for their assets to grow during good times, but also be in a position of defense, when we go through down times. And certainly this is one of those down times. Really, a month ago, even say mid-February, markets were hitting all-time highs. The economy was hitting on all these cylinders, and there really wasn't a lot of talk of a downturn or recession. And even with the coronavirus happening in China, we just really didn't have the imagination that it would come to our shores and threaten our health and threaten our economy. So I think this particular crisis does rhyme of 2008 and 2009. Of course, it's not the same. This is really a healthcare crisis, and that one was really a financial crisis. But some of the effects are definitely the same. We're having a dramatic sell-off in the stock market. We've got people very worried about their futures, and it was really the same back then. We're facing, I think, a lot of layoffs and unemployment in the weeks and months to come. So my thoughts around all that are, ultimately, we really won't see light at the end of the tunnel until we have either some sort of treatment or some sort of absolute cure through a vaccine. So it's really then how are we going to bridge between right now and when those things become announced? If you certainly certain industries are going to be more affected than others, as everybody sees on TV. The healthcare business, or not the healthcare business, travel industry, airlines, restaurants, anything related to people traveling or socially interacting is going to take a hit. And I think there's going to be, already is, hundreds of thousands of layoffs pretty quick. So I don't think that there's any question that the first quarter and then pretty much the second quarter forecast for GDP or earnings, corporate earnings, I think is going to be very dismal. I'm hoping that by the third quarter, there's more visibility into either a vaccine or a treatment. And with that, we get the all clear signal and our economy and our society begins to heal. I would say that from the government standpoint and the Federal Reserve, I think they're really starting to get it and are really working to throw the kitchen sink at the problem. But unfortunately, it's not money that's going to fix the problem. It might alleviate some of the stresses that the problem is causing, but it won't be until we have a cure, really, until that problem is truly solved. So with that, we've seen overnight what was a country of sellers in just about any category that you can name to really a market of buyers. And as we look at the stock market overall and we look at underneath the hood, what we see is a huge opportunity where expensive, high quality, large cap stocks are really selling at a deep discount. And so the old proverbial throwing the baby out with the bathwater is definitely going on. And we're looking at this as an opportunity to improve the quality of the underlying stock portfolio, whereby we're able to own some of the superstar winners at really, really reasonable prices. So that's one move that we're looking to take advantage of. We're also looking to take advantage of improving our bond quality and the liquidity thereof. And overall, just use this price opportunity to improve the quality of all of our portfolios. So while it's really difficult right now, and I think it's going to stay difficult for a while, and I don't think the news is going to get better before it gets worse, we do see this as one of the investment opportunities of a lifetime or decade. We saw it in '87, we saw it in 2001 and 2002, we saw it in 2008 and 2009, and now we're seeing that opportunity in 2020. I don't think we'll ever be able to pick a perfect bottom, so we'll probably buy on the edges as each day shows any further down. But certainly around these prices, you'll see us dipping our toe. The other thing you'll see us doing is making trades to capture temporary losses, and we call that tax loss harvesting. We did that same thing in 2008 and 2009, where we were able to sell security A and buy security B that was just like security A. So we weren't really moving our position, but by capturing a loss, we were able to offset future gains for years and years and years, and we saved tens of millions of dollars for our clients in doing that. So we'll be doing that now. You'll be seeing trades coming through both in equities and bonds, while at the same improving the quality of the portfolio. So with that, I would say just one last thing. So about 9 months ago, maybe 9 months ago, maybe a year ago, we started talking about getting ready for a downturn. And we said we had an 11-year bull market. We hadn't had a recession in 10 or 11 years. And intuitively, we just knew that at some point in time, we were going to have a pullback. So we created a new tool for all of our families, and all of our families have gone through this exercise, whereby it's called the Recession Prep Scorecard. And with the Recession Prep Scorecard, we went through 6 different categories we felt were important that would either help them through a recession. You can show that, Chad. Or where they could beef up that area so that they would be more prepared for a recession. Well, as it turns out, we were a little early. The markets continued to rally as we were talking about recession. So we were kind of, people were saying, you didn't sync with things. We were thinking that ourselves, really. But not calling this coronavirus meltdown, we just have now find ourselves as prepared as we can be for this. We feel like we have dry powder for clients so that we can opportunistically buy. We've hedged our portfolio with insurance vehicles, and we are in a position of really strength to take advantage of these weaker prices and better capital gains in the future. So any of you on the call that would like us to look at your stuff or have you go through this recession prep scorecard exercise, we're happy to do it. I should also say that people, when everything is going up, people tend to be pretty happy with what they're doing. But when things are not going well, that's when they look to see whether they're as well positioned as they thought. So if there's anybody in your network that would like to talk to us, we're open to having those conversations. So with that, I'll turn it over to Chad Hamilton.
Thanks, Mark. So we've got 4 bullet points we're going to cover in our call today. A lot of the first bullet point Mark already talked about and touched on, which is commentary on the economy and COVID-19 or the coronavirus. Second, we want to talk about the resilience of the stock market, give some historical perspective. Third, we want to talk about the impact of volatility for those nearing retirement or in retirement. And then lastly, what can you do now? How do you prepare for a recession and stress test your portfolio? Again, you saw a little bit of that just a minute ago, a little sneak peek, but we'll get into that in a little more detail. So when we think about, a lot of you have probably seen this this chart or some version of it. What the market cares most about right now is not primarily what the Fed is doing or even the economic reports. What's most important is the state of the virus itself and those health concerns. I'm sure a lot of you, have seen some version of this. This dotted line indicates the healthcare system capacity, and then what we're trying to show here is the advantage of smoothing out that line and what a containment strategy could do to alleviate stressors on our healthcare system. Unfortunately, in Italy and Iran, they've had situations more like the red curve here, where their capacity for treating patients was overloaded. There's simply not enough beds, ventilators, even doctors to treat everyone who needed it. And experts are pretty much saying that this could have been avoided with drastic types of measures, exactly the types of things that we're taking right now in the United States. And I'm sure everyone's familiar with shutting down schools, churches, sporting events, concerts, air travel, and so on. It seems extreme, but potentially could save hundreds of thousands of lives in our country. But in the process, undoubtedly inflicting a lot of financial and economic pain. So with this sharp decline of global economic activity, we believe there's a high probability, almost a certainty, that we'll be entering into a recession. The question is, how quickly can the economy bounce back? And that's going to depend first and foremost on the outbreak itself, how effective containment efforts are, as well as vaccines and treatments for it. And then secondly, the fiscal response. To what extent is the government able to move quickly and substantively to help so many affected, especially small business owners, to be able to sustain through this. And of course, you see a lot of that already happening in the news. So here's what we're looking for and anticipating. The more actual data that we get about the spread of this virus, the more certainty, and I would put that in air quotes, but certainly less uncertainty that we'll have, and therefore the less fear will rule the day. So the more data that comes from widespread testing and those results, the less the markets will be ruled by panic and fear of the unknown.
So one thing I just I'm observing is people are using China as somewhat of a benchmark to recovery. I'm talking as loud as I can, Justin. So anyway, the thing about China is that they're an authoritarian government, and they can, if they say stay in your house, that's what people do. They stay in their house. So while I think we've taken very positive steps in the last week to do the things we need to do to shut the virus down, I don't think we can compare it to China because I don't think we're doing what China did. So it's probably somewhere in between what China's done and maybe, I don't know, what Korea's done, but definitely not. We're not in total lockdown. Some people argue that that's what we should do, is just go into total lockdown and just get it over with. So time will tell who's right.
We want to talk a little bit now about the resilience of the stock market from a historical perspective, and also talk about and show how the market moves ahead of the overall economy, because that's something that's going to be really important and has been already in a lot of discussions that we're having and the things that we're watching. So this chart, it just shows 80 years of stock market history, and it's the period from 1940 to the beginning of 2020. It's an 80-year period. The markets returned 10.6% annually over this 80-year period, but there's no shortage of reasons to worry along the way. Right, in the 40s and 50s, we were immersed in foreign conflicts, World War II, the Korean War, food shortages, labor strikes. And then in the 60s, you had the Kennedy assassination, the Vietnam War, and just in general, large cultural upheaval. In the 70s, we had the energy crisis and a terrible bear market from 73 to 74, interest rates at all-time highs in the late 70s and early 80s. And then, in the 80s and getting into the 90s, we had Black Monday, the LA riots. And then at the beginning of the new millennium, of course, the corporate scandals, 9/11, the global financial crisis, more recently, Ebola virus outbreak, the surprise election results of 2016. And then now we're dealing with the coronavirus. All that to say that these events that rock the markets, rock the economy, are almost always out of left field. Almost never does anyone predict these things. No one was predicting or talking at all about the coronavirus in even early January, certainly not at the end of 2019. And this, of course, is the thing that everyone's talking about right now. That's not uncommon. And that's part of the reason, to Mark's point, that we wanted to prepare ahead of time, because there's no one that has a crystal ball on these things. The other point to make, though, is that we get through it. I mean, if you just try to think about some of these events and the mindset and the thought process and the headlines, they're all in their own way terrifying. So yes, they're all different. They all have different characteristics, but from a market perspective, history seems to rhyme, as Mark likes to say, and these things, these patterns, these cycles do tend to hold true, and through every single one of them, the market's gone on to set new highs. So it is important, and I feel like we feel like helpful to look at that history a little bit. Now, with all of that, some people, you might say, well, it seems reasonable to think if this is going to get worse, and we would admittedly say the headlines could and probably will in some ways get even worse going forward, then why not just cash out and sit on the sidelines for a while? And the answer has a lot to do with the way the markets and the economy work together. the markets move ahead of the economy and has priced in a lot of bad news already.
And I would say that we have, as a firm, virtually zero net sellers at this point. We had virtually zero net sellers in 2008 and 2009. And it's mostly because we've demonstrated to our clients through planning and the retirement shock absorber primarily that they can withstand short-term hits and it's not going to affect their long-term plan. And then when Chad showed you some sort of startling facts about rebounds, you'll see why we typically want to stay fully invested. But also we want to take advantage of discounted prices and start doing some buying as well.
Yeah, thanks, Mark. And of course, we can't do a presentation like this without quoting Buffett at some point, but he just says certain things so well. So he said this in October 2008, right in the midst of the calamity when everything was happening at that point. He said, "Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So if you wait for the robins, spring will be over." This chart just illustrates that a little bit. If you were looking at that time period, starting at the beginning of 2007 and all the way through, it's not quite through till today, but close to. And what we're looking at is large cap indices, so big blue chip companies. The light blue line is just that market over that period of time. And the overall return over those 11 years of the S&P 500 was 290%. It equates to about 13% per year annualized. That's through Monday, so it does include most of this downturn that we've seen just recently. Second, and I think this is really important, is this gray shaded area here is a recessionary period. It was about an 18-month recession from late 07 through mid 2009. And what's instructive here is this sharp rebound in this blue line, the light blue line, that was underway well before the end of the recession in mid 09. Now, the thing about that is that even when this recession ended, the economic headlines were pretty terrible. It's not as if everything was good at that point. Everything still felt pretty bad mid 2009, but the market had already rebounded significantly. And so, so what this chart just shows is what happens if you had waited for a year and got out and invested a year later in March of 2010. And in that case, you would have had about half of the results you would have otherwise earned if you stayed in the market. You would have had about 150% total return as opposed to nearly 300. And the green line is just if you had gone to cash and missed the bull market altogether. So this quote sums it up nicely. It says, some people say they want to wait for a clearer view of the future, but when the future is again clear, the present bargains will have vanished. In fact, does anyone think that today's prices will prevail once full confidence has been restored? Any guesses on who said this or when it was? Actually, never mind, you're all on mute. So it was Dean Witter in May of 1932. This is just a few weeks before the end of the worst bear market in history. It's in the midst of, right in the middle of the Great Depression. And of course, he was exactly right, but it sure didn't feel that way. And that's sort of the moral of the story here. So if we look at and we think about, what that felt like in late 08, early 2009, these were indicative of a lot of the magazine covers that you would have seen at that time. And think about this. Following one of the worst years for stocks in history, 2008, call it 50% or more on the downside, equities were down another 28% at the beginning of March of 09. So outflows at that point were near historic highs, and it was just a reflection of investors saying, "I've had enough. I've got to get out." And so but the problem with that is in '09, from the market bottom on March 9th through the end of 2009, the market was up almost 70%. There was 68% recovery just in the course of the 10 plus months of that year. If you missed the 5 best days out of about 300, just the 5 best, your returns would have been more than half less than the overall. You would have missed more than half of the recovery. And then if you missed the 10 best days, you would have had only 15% of that recovery, well under a quarter of the total.
So it's really impossible to guess those 10 best days. So the moral there is that if you try to time in and out of the market in a big way, it could have pretty devastating negative results.
Yeah,
but I will say, as we're talking about this, we really haven't had to convince anybody to stay in the market right now. We haven't gotten those calls where we're having those conversations. So I don't want to give you the impression that we are. Maybe we're worried that we might, but right now that's not the tone of our clientele.
Yeah, I'm sure many of you are familiar with some version of this chart. It's just the emotional life cycle of investing. And so the quick version of this is, for the successful investor, the time to worry, the time of maximum risk is when no one seems worried, not when everyone does. Our goal in preparing for recession repeatedly, and Mark alluded to this at the beginning, was exactly that. We didn't know precisely where we were here, but we felt really, really confident that we were closer to the top than the bottom. And after, in the midst of one of the longest bull markets in history, we said, let's take some chips off the table. Let's have some dry powder, because everyone says it in times like we're going through right now. It's a great buying opportunity, but how often do you actually have the funds to buy at that point? A lot of times people are fully invested, and so it sounds good, but you can't really do it. But we do have that for most of our clients. They agreed with that philosophy. They have some cash, some dry powder to be able to take advantage of that, which we've just started to do in smaller increments thus far, but we have a lot more opportunity there. And then, so this is where, we look at this maximum opportunity. The best investors, this is really important, I think, to remember. They like situations where panic is full blown and conditions appear utterly certain to get worse. That's true for Warren Buffett, Peter Lynch, Benjamin Graham. They all have either articulated or acted in concert with that idea. So we don't want to give the impression, with the cliche, just invest for the long run and don't worry about it. It's not that simple. It's not the entire story. If you're 35 years old, the best advice is probably, just invest for the long term. Volatility is not going to harm you. In fact, if you're adding money along the way, it might even help. But the thing is, if instead of 35, if you're 55, or if you're on the verge of retiring, volatility does matter a whole lot.
Or if you are retired.
Right.
Yeah.
It can really derail you from reaching your goals. So I just want to show you, and by the way, we're not trying to scare anyone here. It's a piece of education that we found that's really eye-opening for people. This is something that we tend to use with new clients, because this is really important for them to understand as we're building a portfolio, and so they understand our thought process here. So what this shows is the 20 years of market returns, starting at the beginning of 2000 all the way through the end of 2019. The S&P 500 index, and it's saying you start with $10 million, and over that time, the average return was 7.7%, so the 10 million grows to 32 million. Please don't worry about the numbers. If you have 10 times less or 10 times more, all of this still holds true. It's the problem with using examples is sometimes people can latch onto the numbers themselves. So that's the left-hand side. The right-hand side, the only difference is we flip the returns. And so we say, let's start with the rate of return for 2019 and work backwards through 2000, and it's the same result. That 10 million grows to 32.5 million. It's 7.7% average return in both cases. It doesn't matter how you get from point A to point B if you're in accumulation phase. Now this piece is all the same assumptions except for one change. And that change is to show and assume a withdrawal, an annual withdrawal of 4.5% or 450,000 a year increased with inflation. And in this case, what you see is that 10 million is depleted down at the end to nothing with this first scenario. In the second scenario, the 10 million grows and actually increases, almost doubles to 17.8 million. The only difference, keep in mind, the average rate of return on just from a pure index standpoint is the same. The only difference is we have withdrawals. And so what does that tell you? Well, it tells you that the sequence of returns matters a lot. How you get that average return matters a lot when you're pulling down from the portfolio. And so the point being that it's really important to stress test your portfolio and make sure that you mitigate the downside risk in any number of contingencies. The other thing, and I'll get more to that stress testing in a moment, but the other thing I just want to note, if you have a liquidity event, selling a business, selling real estate, and you have cash to invest, another takeaway from this is we are big advocates, especially in a choppy market like this, of opportunistic or systematic investing as opposed to just putting it all in at one time. And the reason for that is if you invest systematically, and we're looking over the same time period, mid-08 through the end of 2009, we looked at it and we said, what would happen if you invested all at once? You would buy 35,000 shares and change on, as of the end of September 08. Now, then what if you had the same amount of money, but you spread it out over 6 different quarterly investments? In that case, you end up with 10,000 more shares, even though you invested the same amount. Now, why is that? Well, with the systematic plan, you're investing more, or you're buying more shares when the price is low, and you're buying less when it's high. And it's just the nature of that kind of plan. We think that in this kind of market, that is particularly effective because, if it trends lower, you're going to continue to buy more shares. But even if the trend is upward, we don't think that this volatility we've been seeing is going to stop. It's going to be a jagged move in either direction, which tends to favor that type of approach. And this just shows it graphically. I mentioned stress testing, so I just want to make a note of this in terms of how this works. So what we like to do, and we do this internally for our own clients, but for prospective clients, we can actually show a report like this if they're interested. If anyone on this call is interested, we're happy to do that, just give you a second opinion. But it's basically what we want to say is, let's look at a number of different what-if scenarios and past crashes or downturns and ask the question, what if this happened today? In the case of a severe or deep recession, what would that look like, right? And in this case, we're seeing a portfolio that would be down 32%. A risk managed portfolio might be down more like 20%. And then we just look at different scenarios along those lines, because the premise there is we don't know exactly how it's going to shake out, but we think that, it's important to look at different possible negative scenarios. I think the last part of this is, okay, what now? What are the action points at this point that you should be thinking about? The first thing is to have a comprehensive financial plan. Mark mentioned that right at the beginning. This is our approach. We look at goals and we build a plan around that because that gives the framework and context for good decision making. This is the tried and true core of how we do planning. We've had this for a long time now. It goes all the way back to, I don't know, the early 2000s or earlier, Mark, probably late 90s. And it's the retirement shock absorber. And what we're showing here is we try to simplify the complex. So the numbers behind it aren't simple, but the way that we're showing it hopefully is, and it's just the capital available shown in blue here. This is all the assets that you have. We're assuming 5 million in this case, and the capital need is in red. And that's the present value of all your future expenses, how much it takes for you to live, your standard of living going forward through life expectancy, as well as any one-time financial goals. And in this case, there's a 30% surplus, or what we call a retirement shock absorber. That's the light blue bar here. And that's just what it sounds like. It's to handle those shocks to the market system, in the investment markets that are unpredictable. We don't know that they're coming. And the point of that is to have that buffer, that cushion to handle downturns like we've got right now. We recommend at least a 20% shock absorber for all of our clients. And so what you see here is in a market like this, that 30% might be down to 12%. It's always contingent on individual plans, but let's just say that's what happened in this case. And you have less of a cushion, but you still have a cushion. And that's why that's here, by the way. This is exactly the time why we want a shock absorber. And the point being that you have context. None of us really maybe want to look at statements at this point in time or like to see what's happening in the markets, but we know ultimately that the plan hasn't changed, that we're still okay, and that we had that sort of contingency planning for times like these.
Yeah, and really you're more than okay. I mean, you're able to do the things you want to do, to take the trips, although no one's taking trips right now, but make the commitments that you've made, and not really have to change the standard of living in a dramatic time. Sometimes people will cut back just out of human nature, but they don't have to. So our main thing is that we want to be able to take our clients to retirement, maintain their standard of living through thick and thin. Other things happen too. Things happen with kids, or things happen with parents, or unexpected things happen. So as long as we can build your plan and have a cushion, have a shock absorber, we know that we can go through life without freaking out through the ups and downs as the world turns.
Mark showed this earlier, the recession prep scorecard. We would just say that, when asked where to start, we think this is a really good place to start to get a snapshot of your situation. Hopefully for all the clients on the call, you've heard this ad nauseum over the last year. We've talked a lot about recession prep and the scorecard, but if you haven't seen this, we would recommend, if you said, well, where do I get started with planning? We're happy to help you with this, just to get a sense for where you are. The shock absorber percentage is in there, and part of this that we just looked at, as well as a number of other things that Mark alluded to earlier, and it's all on one page, and it's scored from 0 to 10, so it's pretty intuitive as far as how it's ranked. So 4 things to know, right? We're back to this. Have a comprehensive financial plan. Turn on income. This is a good time to do that. A lot of people, it's all the perennial question, when to begin Social Security, for instance, and when to start receiving benefits. Well, our bias based on where we are in this market right now is to have as much income from external sources as you can, so that you're required to draw down less from the portfolio itself. So this would, in our opinion, for almost everyone, be a really good time to start drawing Social Security benefits if you can. This little graph at the bottom just shows predictable income sources. Let's assume that this blue portion of the chart are dividends and interest from the portfolio, just income from the portfolio. The remaining need would be $180,000. Maybe in this case, someone needs to withdraw from it. But if you can turn on other income, you can actually, if that brown bar includes Social Security, maybe it's pensions, maybe it's annuity income, that can offset a lot of that need and require you to draw down a lot less, maybe nothing from the portfolio. And that's big. For a lot of our clients, we've recommended annuities for exactly this situation. because there's guaranteed death benefits for those, not for all of them, but for ones that we recommend. Guaranteed income withdrawal benefits. And what it does is enables you to lock in at a higher level account value than where it is now as a benchmark for where those withdrawals come from. And this can be a really good time to turn that on. A third point is just minimizing income taxes. Mark mentioned this earlier, but tax loss harvesting, we're starting to do that now, and we think it's a really good time to do that. It doesn't change the general structure of your investment strategy. It just allows us to lock in some losses and carry those forward indefinitely for as long as you need them to offset future gains. And that's something that can be a really good silver lining in the midst of all the proverbial dark clouds right now. Roth IRA conversions are attractive when values are suppressed because you're paying taxes on the account value, and when the account value is down, it's a better time to do it. And then, of course, as it rebounds, all of that growth as well as the contributions in there come out tax-free. And then the last thing I'd say, just really quickly, but we could talk in more detail for anyone that's interested or needs to reduce estate taxes. This is really attractive right now because what you're doing is it's a smaller gift amount that's required to remove assets from your estate and all the future appreciation of those assets. And, you know, just looking at the landscape politically, it's certainly possible that the estate tax exemptions go down. And so this could be a really good and important time to be thinking about that as well. The last thing is just to be opportunistic. Look for buying opportunities if you have the ability to do that. And as we said, we're looking for that. We're looking to upgrade portfolios, we would say, where we, you know, essentially buying expensive investments for very attractive for discounts on the cheap. Some of the best companies in the world right now are on sale. And, you know, you guys have to chime in with any examples if you want. But I think that's an important theme because, and we've seen the numbers, I mean, year to date, there's a huge discrepancy between the performance, everything's down, but the performance of large growth companies, which is what we have favored and continue to favor through this market environment, as opposed to, so think blue chip, growth, high quality companies, as opposed to, say, small value companies. And, you know, it's sad, but it's the circumstances of the situation where it's questionable how many of those smaller companies are going to be able to make it. And if they do, are they going to be the same? Whereas a lot of growth companies are investing and innovating right now and they come out even stronger. So that's our theme in general, if you know, just tactically in terms of the types of investments that we favor. And that's it for my kind of our prepared remarks. I don't know if, Mark, if you want to say anything here. Justin mentioned you can submit questions online, and we'll get to those in a minute. We can't open the lines up. There's just too many people. We've got almost 100 people on. So the way that this works is you submit them. You should have a Q&A box. If you look at that, and typically on the top of the screen or somewhere in there, you can open it up, and you can submit your questions that way. We did get, looks like, a few different questions, so we'll kind of work our way through these, but go ahead and submit others as you have the chance.
So, you know, a couple of things I'll just say is that having been, you know, starting the business in 1983, the Dow was at 1,250, believe it or not, and having seen a lot of different market environments, down markets, of course I've learned, and I've got a lot of experience. So I think what we're doing a little bit differently this time around is that we are not taking just a buy and hold approach. While that may be a central part of our strategy, we do have a satellite strategy whereby we are being opportunistic. We did create dry powder at market highs. So we feel like we're prepared to be on the offensive with our plan accounts versus being on the defensive. So you'll see us see activity in your accounts as the days and weeks come. All that we've already talked to you about in advance, so it shouldn't come as a surprise. But we feel very positive about where we stand with clients' investments and their positions. I feel very strong as a team. I feel like our team is excellent. Justin Cassidy has been with me for 13 years. Chad's been with me for 11. Vonda's been with me for 23. Danielle's been with me for 8. We've got just we're all trained in the way in doing this way, the way we do things here at Brown and Company. So we're all have the same viewpoint, and the advice and the things that we talk about are the same. You're not going to get anything different from any different person that you're talking with. Please, we haven't received a lot of phone calls from our clients during this period, and part of it is that I think sometimes people think that they don't need to, they don't want to bother us. Well, it's not bothering us. It's what we're here for. These are the times that, if people want to talk things through, this is the time for us to do that. So if you don't hear from us and something's on your mind, please don't hesitate to call us. So I guess we do have a couple questions.
We have a lot of really good questions. With respect to time, we apologize if we can't get to everything. We'll try to group ones that have similar themes. One of the questions, and this is a good one. So where do you, I'm just going to minimize this for a second. All right. So a question is, what do you have to say to clients under the age of 35? And in short, I would just say go back, and everyone's going to have a copy of this presentation. We'll email it out to you. But I would say that a chart like this is really important for someone who's adding money to a portfolio. Basically, the moral of this is, and this had to do with these systematic purchases, over time, if you're adding money to a 401k or just an outside investment account, you're buying more and more shares as the prices are low. So even without knowing it, you're getting really good bargains and values right now. And this is a really good time for someone that has that kind of time frame. And the only question is, if you're optimistic overall about our economy, and you go back to that market chart that I showed, and that this, terrible calamity that ranks up with a lot of others along the way, that we're going to pull through it just like we have with others. If that's your mentality ultimately, then this is a really good time to be in the market. Another question that came in was, what sectors do you favor? Now, sorry, I'm just going to pull through because I think we might have like a bonus slide at the end that'll show this a little bit. This doesn't, I don't know that we have the time to get into specific sectors right now, but these are the style boxes. And so if you think about, just say the technology sector, okay, that would be large growth is generally where that falls in here. And those types of companies are faring much better, and they did last year as well on the upside, than a lot of other companies. So you can see the differential year to date between large growth and small caps, especially small value. And then even, these are US as compared to international. So there's a theme there, and I think that we still believe in that theme. That doesn't mean that some of these value companies that are really beat up can't be good value and good buys as well. Like we had a question around oil and gas and what do we think about oil and gas. It's just, I think you just need to.
It's a speculative trade.
Right.
So not that it's a bad trade. We've dabbled in oil and gas over the years. I think got out of it about a year and a half ago. Yeah. And have been out of it. But I got a text from a client this morning saying we should have bought oil yesterday because it bounced back today. Anyway, but I think it's a speculative trade right now. There's some geopolitical goings-ons that we don't know anything about. I was listening to somebody on CNBC today that basically said that if we need to protect our oil and gas business because it's part of our national defense, it's part of our economy, it's part of our So I agree with that. I suspect that that will resolve just on that one reason alone. But we definitely have been a surprisingly net exporter of oil and gas over the past few years, which was certainly not the prediction in the 70s. So I would say that we probably are going to protect that industry. I just don't know how exactly right now. There probably is consolidations coming, but I know the person that asked that question is very knowledgeable about the oil and gas business, so we'll talk more about that. But I will say that even looking at this chart, we've overfavored growth to pretty much everything else over the past 5+ years. I don't see that changing. In fact, I think we probably take it, if we like it at those prices, we probably like it even that much more at the prices that we see right now.
So there's a question about, can you gift stocks from a trust while the value is down without tax ramifications to the receiver of the gift? I think we should probably follow up individually on this one. I would just say that trusts are tricky because there's a lot of different types of trusts. And so depending on whether it's a revocable trust or irrevocable trust will make a difference on who's responsible for the taxes. And then even within, those categories, different types of trusts, depending on the situation, will have different tax rates, as will beneficiaries based on who it is. So I think we can follow up individually on that one, but I think it's a good type of thing to be thinking about right now. There's a question, what is the expectation on the estate tax?
That's really a political question. Right now, that sunsets, right now you give about 21, 22 million away tax-free. But for, a couple. And in 2025, that sunsets to a much smaller number. I can't remember, $5 or $6 million. And so we won't, a lot of people are making estate planning decisions right now, knowing that that's going to sunset to capture the higher $22 million number today. And I still think if you can afford to do that, that is a financial planning question. I always say the best way to reduce your estate tax is to give all your money away, but then you don't have any money. So you don't want to do that. So it's a balancing act between what you need for yourself and what you can afford to give away.
There's a question about, am I understanding correctly that during this buying opportunity, you will be investing in individual stocks as opposed to mutual funds or ETFs, as has been the preponderance historically?
That's a case-by-case basis. So I've talked about individual stocks because, I'm watching some favorite names at really good prices. Right now, functionally, we do not have discretion on client accounts to buy individual stocks. We have to make a phone call to do that. So I was talking to Justin about that yesterday, saying that we should get discretion for those that want to buy stocks. Because in the heat of the moment, making individual phone calls to every client is impractical. You have given us discretion on mutual funds, ETFs, and commingled funds. So we don't need to make phone calls, and we've already got a plan in place before so that we can execute on that plan as things are happening. Yeah. But I do like it. I like the idea. It does mean that in the portfolio, you might have some winners and some losers, and it's not quite, it's more concentrated. So you definitely have to have more appetite for risk in doing that.
The other thing too, when we, in an educational format like this, a lot of times it's easier to mention individual stocks because they're more relatable than say a name of a mutual fund. It doesn't mean as much to people. But of course, a lot of those same names are going to be in these funds that we're buying, either ETFs or mutual funds. So we certainly get exposure to the types of companies that we like one way or another. All right, I think we're good. We want to be respectful of everyone's time. We appreciate everyone being on the call, asking questions. obviously we're available, and we hope that you reach out to us individually if you have anything else. But
really appreciate your time. Thank you very much for your confidence you placed in Brown & Company and the Brown & Company team. And be healthy. Hope you're having fun at home, learning a new language, playing your guitar. Anyway, thank you very much. Talk to you soon.
Bye. Bye-bye.